Welcome. When it comes to passing wealth to your family, what you leave behind matters far less than how you leave it. I've seen estates where the beneficiaries inherited tremendous value but ended up worse off. I've also seen modest inheritances that multiplied in impact because they were structured right. The difference isn't luck, it's understanding which assets transfer smoothly and which ones create problems. The clear winners and the hidden traps. Let's start with the assets that make heirs' lives easier versus the ones that complicate everything. Cash wins for simplicity. Boring doesn't begin to describe cash. There's no mystery, there's no waiting period, there's no appraisal dispute. When someone passes away, families face immediate expenses. Funeral arrangements, property taxes, ongoing mortgage payments, maintenance costs. Cash solves these problems instantly. It's liquid, divisible, and requires zero interpretation. Nobody inherits cash and thinks, now what do I do with this? That matters more than you think. And while you shouldn't park everything in cash, having some available means your family has breathing room while everything else gets sorted out. Compare that to timeshares. I'll be direct. Timeshares are nearly impossible to give away, let alone inherit productively. They come with annual fees that don't stop. They come with restrictions on usage. They're difficult to sell. Many families inherit a timeshare and realize within months that they've inherited a bill, not an asset. Your family doesn't need locked-in costs and limited options during a time when they're already stressed. Life insurance provides speed. Life insurance is straightforward to administer. Beneficiaries get access to funds quickly. There's no lengthy probate process. There's no valuation dispute. The money arrives when your family actually needs it to cover immediate obligations, pay down debt, or simply stabilize their situation while they're grieving. That speed and certainty have enormous value. Now, contrast that with inheriting a collection of hard-to-sell items. I'm talking coins, rare vehicles, specialty memorabilia, firearms with specific legal requirements, art, jewelry, boats. These things look impressive on paper. In reality, they become headaches. Your heirs will need appraisals. They'll need storage space and insurance. They'll need to find knowledgeable buyers in niche markets. They'll often get taken advantage of because they don't know the market. And there's always pressure. Either find a buyer or keep paying storage and maintenance costs. Life insurance gives your family money. Collections give your family a project they never asked for. Appreciated assets and the step-up rule. Here's where tax planning becomes critical. Let's say your parent bought stock for $50,000. By the time they pass, it's worth $400,000. That's $350,000 in unrealized gains. If they sold it while alive, they'd owe capital gains tax on that $350,000. That's a significant hit. But here's the powerful part. When someone inherits appreciated assets at death, those assets receive what's called a stepped-up basis, meaning the tax foundation resets to the current market value. Your parent's heir now inherits assets worth $400,000 with a new cost basis of $400,000. That $350,000 gain essentially disappears for tax purposes. Your heir could sell immediately and own nothing. This applies to stocks, bonds, real estate, business interests, cryptocurrency, any asset that's appreciated. It's one of the most valuable tax benefits available. So what's the worst move? Selling appreciated assets before death to simplify things. You trigger the tax unnecessarily and hand down less wealth than your heirs would have received. You voluntarily paid a tax bill that might never have needed to be paid. Real estate, the difference a plan makes. Real estate can be one of the best inheritances or one of the worst. It depends entirely on planning. With a plan, it's excellent. That could mean clear instructions about who gets the property, whether it's sold or held, which child inherits which asset. Maybe your daughter loves the family home and inherits it, while other children receive cash or investment accounts as equal value. Maybe your vacation property goes into trust with specific instructions about how decisions are made if multiple heirs own it together. Real estate gets the same stepped-up basis benefit as stocks, which is tax favorable. When there's a roadmap, families thrive with real estate. Without a plan, it becomes destructive. I've seen families inherit a vacation home or cabin with no instructions and end up in years of conflict. One sibling wants to sell, another wants to keep it and use it seasonally. One can't afford property taxes and maintenance. One lives nearby and thinks they should have more say. Now your family isn't inheriting an asset, they're inheriting negotiations and resentment. Meanwhile, insurance, property taxes, repairs, and maintenance costs keep mounting. The property that was supposed to be a family legacy becomes a burden nobody wants. Real estate without clarity destroys relationships. Retirement accounts, the tax trap. A Roth IRA is typically one of the cleanest inheritances available. The money grows tax-free inside the account. When heirs withdraw it, they don't face income tax. It's straightforward. A traditional IRA or traditional 401k is the opposite. Let's say your parent leaves a traditional IRA with $100,000. Your heir inherits it, but every dollar they withdraw gets taxed as ordinary income. If they're in a high tax bracket, they could lose 30, 40, or more percent to taxes. The account looks like $100,000, but it's really worth considerably less after taxes. This is one of the most misleading inheritances because it appears substantial while hiding a built-in tax bill that nobody asked for. The gap between a Roth and traditional account being inherited is enormous from a tax perspective, even if the account balances are identical. Family businesses. Structure determines everything. With a succession plan, it's potentially excellent. You've documented who manages operations, you've clarified voting rights, you've explained whether all heirs own equally or if some work in the business while others are bought out. You've set expectations and created stability. Your family inherits a functioning business with clear leadership and direction. Without a succession plan, it's chaos. Your family is grieving while simultaneously trying to figure out payroll, customer relationships, who's actually in charge, whether the business should even continue. That's the worst possible time to start building a management structure. The person who typically kept things running is gone. Critical relationships and decisions are unclear. Heirs who work in the business clash with heirs who have no involvement but want a voice. The business often collapses or gets sold at a disadvantage because nobody had time to plan properly. The common mistake. Families make the same error repeatedly. They do the hard part halfway. They create a will but never fund a trust. They start a trust but leave key assets outside it. They own a business but never create a succession plan. They hold appreciated assets but sell them right before passing, triggering unnecessary taxes. They put a child's name on a house late in life to avoid probate, which actually costs them the stepped-up basis on that property. They leave vacation properties to multiple heirs and expect the family to figure it out. Spoiler, they don't figure it out. They fight. What actually matters? The best inheritance isn't the biggest one. It's the one that transfers cleanly, minimizes tax friction, avoids family conflict, and preserves as much wealth as possible for the people you love. That's why your choices matter. Cash provides flexibility. Life insurance provides speed. Appreciated assets provide tax efficiency when inherited rather than sold first. Real estate provides value when there's a clear plan. Roth accounts provide tax-free growth to heirs. Family businesses provide continuity when succession is planned. The worst inheritances aren't necessarily worthless assets. They're valuable assets with no structure, no plan, and no guidance. That's how wealth disappears and families fracture. The best legacy isn't measured by the dollar amount. It's measured by how well your family can actually use what you've left them, and whether they stay united doing it. Stay informed. This is USA Tax.